Welcome back, folks, to Investor Diaries. We've all heard about terminologies such as companies going public or IPO, which is initial public offering. And we wanted to use this time to discuss more about the ways and means by which a company can go public, and we as retail investors can start trading the stocks of that particular organization.
An IPO is a process by which a private company issues its first shares of stock to public for sale. This is typically known as the process of going public. Beyond structuring a firm's shares for sale, the process also includes establishing stakeholders of the company and creating regulatory compliance aimed at financial disclosures and transparency. Keep in mind, when a company goes public, all the financial statements, all the information that the company has is available to the public, and it needs to adhere to certain regulatory and compliance measures before listing in a stock exchange. The process exists to protect the investor public from purchasing shares in fraudulent companies and to avoid losses from the retail investor side.
So why does a company really file for an IPO, or why does it go public? So at a high level, IPO can be an opportunity for businesses to rake in some good sum of money, which they can use to ramp up, say, hiring, which they can use for operational efficiencies, or which they can also use for some merger and acquisitions because now they have more money. One of the other reasons is that some of these private companies, they can be under pressure from their investors to go public. That's because the venture capital or the private equity firms that have funneled money into the company actually want to realize a profit at some point of time. Because as you might have seen, there's a huge startup scene going right now. There are lots and lots of investors who put money in it, and at some point of time, they do want to realize a profit. One of the other reasons could be that a company has become too big in itself to be brought over by another company. For example, say Lyft, Uber, Airbnb, they had garnered extraordinary valuations before they decided to go public. So for a private firm to take over these companies before they went public was simply not possible. Although this point is not discussed a lot in public domains, but employees or original employees of startups actually can get pretty anxious to have a company go public, because remember, if they are original employees, then they stand to gain the maximum if the company goes public, because their stock options would have started with very low valuations, and when a company goes big, their valuations inflate and they stand to make a lot of money. So typically there are three ways that you can go public. There's the traditional IPO route, there's a direct listing route, and there's the third one, which is via SPACs.
Now let's dive into the traditional IPO route. The traditional IPO route is typically a lengthy process. And in this process, the company and the underwriter of the IPO partake in a roadshow where the company's top executives present to the investors the various nuances of the company. The event can take a long time and often results in company having to wait for months or sometimes even up to a year to receive any capital from the IPO. Traditional IPOs come with some disadvantages though, as the underwriter charges a fee per share which can typically range from 3 to 7%. This means that a significant portion, sometimes totaling in hundreds of millions of capital raised, goes to intermediaries.
As a recent example, Spotify went the direct listing route, and in doing so, it didn't have to pay any money to the underwriters. It just hired a few advisors for a flat fee, thereby saving all the money in the process. An important point to note is Spotify is already a famous company, and therefore, when you do road shows, you have to tell people about the company, make your company popular. But in this case, Spotify was already a popular company, so it didn't have to garner, say, additional publicity by means of a traditional roadshow. Direct listing has a few other advantages. So it doesn't come with all the restrictions such as lockup period, which is associated with the traditional IPO process. And second is that a company can avoid diluting any existing shares. For example, if there were 2 million outstanding shares of, Spotify before it went public, there were exactly 2 million shares of Spotify after it went public. So you see that no new shares are created.
Now, there's another way where companies choose to go public, and this process is kind of becoming more and more popular these days. The third process is SPAC, or Special Purpose Acquisition Company. This represents the most complex type of fundraising for new companies. A SPAC is a company that typically has no commercial operations and is strictly formed to raise capital through an initial public offering for the sole purpose of acquiring a company and taking the acquired company public. Now, we've spoken about SPAC at length in a previous video, and if you're more interested, if you want to know more about SPAC, you can click the link in the description below. SPACs usually have underwriters and institutional investors before offering shares to public, which also saves the company a lot of money. Small companies can make a tidy profit by selling to SPAC, as it can typically add around 20% to the sale price compared to a normal private equity sale. It also offers business owners a faster route to IPO than having a guidance of an experienced partner. It also offers business owners a faster IPO process as they have the guidance of an experienced partner. Even better, as most SPACs are run by experienced business investors who've had a lot of experience in running hedge funds or running investment vehicles, the young companies benefit a lot from their investment expertise and do not have to worry so much as about swinging investment amounts or shifting negotiations.
So, in conclusion, there are three methods to go public: traditional IPO, direct listing route, and via a SPAC. And one isn't necessarily better than the other, but there are reasons based on which a company decides to take a particular route. A common trend that has been occurring is that the traditional IPOs have reduced in volume if we were to compare it to the previous decade. But there are a bunch of reasons associated with it. So, this is it, folks. Our coverage on the different methods by which a company can go public. If you want to know more about any one of these methods, please leave a comment in the section below and we'll be sure to cover it. Until then, thank you so much.
Thanks, everyone.